The US dollar has dropped to the lowest level in 4 years, according to the dollar index, which is a basket comparing it to many of the major other currencies in the world. Now, key to this is the fact that Donald Trump has essentially said that he sees this as a positive. Generally, you would think that a currency should be strong and the weakness of the currency is indicative of concerns around the economy. Well, he sees the positives in it. There's knock-on implications. We've seen volatility across other assets, and therefore I thought it worthwhile looking into this, seeing whether we think we're going to see further downside for the US dollar and seeing what the implications are for other assets and the implications for your portfolio if you're holding US stocks or utilizing foreign or international markets as well. So as we can see here, first and foremost, this is exactly what we've seen from Donald Trump. He says the value of the dollar was great when he was asked whether it declined too much. And essentially, he said that, look, many of the Asian countries have been trying to lower the value of their currencies for years. And so us having a weak currency is a good thing. Now, like I said, hitting a 4-year low, not necessarily a sign of confidence in the US right now, but certainly it comes with benefits. And that's worth talking about. Of course, when you have a strong currency, it makes it quite difficult for your exporters to compete around the world. And that's why if you plot the likes of the Japanese yen against the Nikkei 225, you can see that a weak Japanese yen has underpinned strength for the Nikkei 225. When you see a strengthening of the yen, then suddenly the Japanese exporters are less competitive around the world in terms of their pricing, and therefore we see weakness in terms of the Nikkei. And so there is a perception that maybe a weak dollar would be good for US stocks going forward and US companies. And you add that onto the tariffs, and you've essentially got US companies that are not only competing with foreign imports that are much higher because of the tariffs, but also when you add the FX implications, a 10% tariff could actually look more like a 20% tariff when you add in the fact that the US dollar has declined over 10% since Trump's come into power. Now, when we're talking about Trump coming into power, this chart that I showed you many a times, but notably around the election, we've been tracking this, and it's been remarkable to see it continue to play out. Now, the next leg lower in the US dollar is here, and we're heading towards the kind of lows that we're seeing from the previous tenure of Donald Trump back in 2016, 2017 was when we were seeing these declines. And so you can see there is the possibility of further downside. But if we were to follow this to a T, it would signal the potential for things to stabilize before too long and potentially strengthen. But we don't necessarily know whether it's going to abandon this blueprint or continue apace. In terms of the sort of outlook, in terms of the performance of many of the currencies over the course of Trump's period in the White House in 2025 until now, you can see what's been strong and what's been weak. What's been the weakest? The US dollar alongside the Japanese yen, but more recently starting to strengthen. But if you look toward the top end, the strongest currency out there is the Swiss franc. And what's interesting about this is generally when you're talking about the perceived havens within the FX world, you would say it is the Swiss franc, the Japanese yen, and the US dollar. Well, the Japanese yen and the US dollar are at the bottom of the pile, and it's the Swiss franc that's at the top. Does this mean that people are not fearful in any way and everyone's feeling too confident? They don't necessarily feel the need to get into any of these havens. I wouldn't say so, because certainly there have been major concerns, in particular around the tech space, around a potential bubble that could burst, and so many people would want haven assets essentially. You also have the fact that essentially this SMB cut rates well ahead of time, and now we're not expecting anything from them, and you overlay that against, say, a Federal Reserve that has been belatedly cutting rates, you see that differential between the two. But certainly looking at the outlook in terms of the US dollar, you see the potential loss of independence of the Federal Reserve leading to lower interest rates than would otherwise be the case. The question marks around Trump's policies and the breakdown in their relations around the world, the fact that people are feeling less emboldened to buy US treasuries, and therefore that's less money coming into the US dollar and alike. The US dollar story is shaky, to say the least. And therefore, people, if they're looking for havens, they're looking for the Swiss franc. Notably, we're seeing actually the Australian dollar at the top end here. Two things about that. First and foremost, overnight, we've just seen Australian inflation surge 3.8 on the year, but for the month of December, 1%. We're now expecting to see, or markets are pricing in a rate hike from the RBA next week. And therefore, the outperformance here of the Australian dollar seems to be justified on inflation concerns. But you add to that the correlation between the Aussie dollar and assets like copper and iron ore, which are major exports for them. The rise of sort of hard metals, hard assets does provide the basis for strength for the US dollar. Now, in terms of the value of the US dollar, well, much like many other assets over time, they just lose value. That's because of inflation, for one thing. As the price of goods rise, then so the value of your single dollar or single pound continues to deteriorate. So that means a number of things. One thing it could mean is that you feel the need to outperform that sort of downside that you're seeing for that asset, which means essentially your return at the end of the year should be better than inflation. Another thing is that people essentially see it as a depreciating asset, and therefore the value of the dollar maybe doesn't hold in the minds of the investor and pushes them towards other assets, maybe Bitcoin, maybe gold, things like that. Now, recently we've seen a surge in terms of bond yields, and bond yields are a thing that is absolutely critical for markets, but certainly you can see the 10-year at the top, the 30-year at the bottom. The rise in the bond yields for the US certainly isn't done in isolation. There is a perception, number one, of inflation, and that has been lifting it. But number two, there's a perception that many of the countries around the world after the pandemic have taken on too much debt. They're going to really struggle to continue to finance that debt. It keeps snowballing. And so now, with a huge amount of debt that needs to be essentially rolled over and they need to find buyers for it, essentially demand supply dynamics means that there's a lot of supply, there's not a huge amount of demand. And so the bond yields rise. That means the cost of then taking on that debt once again continues to rise and rise and rise, and it exacerbates the problem. So that's why many people just want to move out of fiat assets as a whole, out of US dollars, out of euros. And that's possibly why, or certainly one of the reasons why, we're seeing strength in terms of the likes of precious metals in particular. And it takes us onto this story. So the devaluation of fiat currencies, whether it's through inflation, whether it's through the creation of a bigger balance sheet at, say, the Federal Reserve, the fact that the debt continues to rise, and therefore we'll see central banks likely stepping in to buy that excess bonds, because you don't necessarily have the demand out there in the real world, for some of it. You can see here, and to drive down yields, you can see here that we've been seeing a rise in terms of the value of hard assets. Now, this also ties in with the fact that Trump has essentially created an environment where everyone's just fighting it out over what they could perceive to be critical materials. That might be copper or silver, that could be uranium, that could be rare earth metals, because everyone wants to electrify, everyone wants to move into AI, all this kind of stuff. It all takes materials, and it's limited in nature, and China has, to a large extent, a stranglehold on much of it. So Donald Trump has essentially heralded this new phase where everyone's trying to stockpile. And so you add that to the fact that we're seeing the devaluation of fiat currencies and the need to diversify into sort of hard assets. That's part of the reason why you're seeing strength in terms of many of these, what you would call commodities, but some of them are also essentially monetary metals, the likes of gold and silver, platinum, palladium, really ramping up the buying pressure of late. But then also some of the other ones like aluminium, tin, copper, they also look attractive as we move forward. And certainly as the US dollar devalues, much of these commodities in the commodity space are valued in the US dollar, which means potential upside in terms of commodity prices. Like I said, the holding of US assets at the moment continues to fall. So when Trump came in, he was talking about making sure that it remains the global reserve asset or global reserve currency. And now he's talking about he doesn't really mind about the fact that it's devaluing. So it's one or the other, or maybe it's both, because ultimately he wants it to remain the key asset by which people say value oil in. So he still wants everyone to utilize dollars, but at the same time, he doesn't mind a weak valuation of that asset. But generally, people are just moving away from it, whether they're trying to pay for commodity deals in, say, Chinese yuan, whether they're holding gold instead of US dollar denominated treasuries for central banks. The US dollar really is on the slide. Now, if we're looking at the role that the US dollar has to play in terms of valuations within markets, what you can see here is that the devaluation of the US dollar typically goes hand in hand with underperformance for US markets and potential outperformance for international markets. So as you see here, the left-hand side, for example, when we see that sharp decline, we're also seeing a sharp decline in the ratio between the S&P 500 and the Euro Stoxx 50, so a cluster of the top European stocks. That doesn't always hold true. So you can say, for example, where we saw sort of consolidation in 2025, we actually saw a rise in terms of that ratio as people move back into US stocks. But nonetheless, if you're talking about the US dollar denominated stocks, for a European person, why would I invest in a US company if they could go up by 5%? But if the US dollar goes down by 5%, then I'm pretty much making nothing, right? So I want to invest in stocks that are going to go up within a country that has a currency that is going to go up as well. That's how you get a tailwind to your gains rather than being dragged lower by the FX considerations. What is notable here is that despite the fact that we've seen this weakness in terms of the US dollar, we have continued to see money flowing into US stocks. Number of reasons for this, but certainly primarily I would say that many people hold stocks such as the big Mag 7 names heavily within pensions, for example. And obviously, they're some of the biggest companies in the world. So certainly, it's not to say that suddenly the US market's going to collapse because of the weakness of the US dollar. And generally, if you look over the longer term, the relationship between the US dollar and earnings within the S&P 500 are negligible, quite frankly, because you see a number of different factors coming into play because of it. I mean, look, you could see the fact that a weaker US dollar is good for companies, as Donald Trump says, because it makes them more competitive abroad. But then you could say that US companies are now having to import goods from abroad, say input prices would now rise. So if, say, a tech company in the US was buying goods from Taiwan, shipping it in, creating a product and sending it out, well, all of a sudden their margins also deteriorate because of that higher import price that comes alongside it as well. In terms of the different sort of US dollar conditions, this is really reiterating that point. So under a condition of a weak dollar, generally you see outperformance for European stocks and the vice versa. Generally, when you see a strong dollar, you see outperformance for US stocks. And really that points towards the idea that if you're investing in an index or investing in a stock, really ideally you want to be investing in a stock that's in an area where you see that currency strengthen or at least stable against the currency that you hold within your country. If you're seeing a massive devaluation of that currency, doesn't necessarily benefit you as you move forward, because it essentially weakens the hand of that position or the returns of that position. Now this chart I found interesting, that like essentially, yeah, we're talking in sort of overall terms because we're talking about the idea of the US stocks and relative to US dollar. But bear in mind, some companies within, say, Europe might have much of their earnings coming from the US. And so the devaluation of the US dollar means a devaluation of that element of their earnings. So be aware, if you're stock picking, if you're looking at a company that is heavily reliant on the US as one of their major points of sale, then you have the heightening in terms of their prices to US consumers, but also the devaluation of the earnings that they're earning abroad when you bring them back into that country for you to report. And then finally, I just wanted to wrap things up with a look around tourism, because of course, when we see a weak US dollar, that might mean it's particularly attractive to visit the USA right now. Great time to go over there because you're constantly getting lower prices. But what have we seen? We've seen a collapse in terms of visitors, particularly from Europe to the US. with everything that's happening in the US, the feeling for many is that it's not an attractive place to be, whether it's security concerns or whether it's just a feeling that maybe it's not as friendly a nation to maybe the Europeans in particular that it has been perceived in the past. I'll be very surprised to see exactly what Europe to Canada is looking like in terms of tourism numbers, because personally, I've been to the US 15 times. Never been to Canada. This year, I'm going to Canada. So an interesting one, no doubt. Certainly many implications looking further out. But I would say one of the key things really is that this reiterates the point for many that hard assets is the place to be as we move forward with a weakening US dollar and a continued focus around stockpiling of assets that, particularly if you're looking at, say, uranium, if you're looking at silver, you're looking at copper, they already have a very tight squeeze on the supply demand dynamic. You add to that the fact that people are seeing that sort of weakening of the US dollar and the devaluation of that currency, and you know, it looks even more attractive. So I hope that's been useful for you guys. Make sure to like, subscribe, and follow for more. My name's Josh Mahony, Chief Market Analyst at Scope Markets. Have a great day and good luck trading.